Let's talk about how Duolingo Stock is being manipulated. Now, your first question might be, well, Johnny, how do you know it's being manipulated? Well, it all started from a DCF projection presentation for an investment class that ultimately fell down a rabbit hole after I discovered that 117% of the float is owned by institutions. Now, how is that number possible, right? How can more than 100% of a company be owned? That makes no sense, right? Well, that's what we're going to talk about. We're going to talk about how that number is possible, how they are doing it, and why they are doing it. And there's going to be three mechanisms that we're going to be talking about, and that is rehypothecation, short laddering, and spoofing, as well as why the executive team is a little suspicious, but we won't spend much time on that. So anyways, let's hop into it. So I thought it'd be really cool to include my friend and classmate, Sam Mahana, who's a really smart guy, and he worked on the presentation with me and really helped simplify my technical explanations. So I'm going to hand it off to him to explain rehypothecation in a hypothetical scenario.
Imagine your friend lends you an apple and expects you to keep it safe. You then take that apple and sell it to someone else. Now there's two different people that believe they own an apple when there's only one apple in existence. This is called rehypothecation. This is how that 117% institutional ownership number is possible. Banks do this with your money. They're using your collateral as their own collateral for their own transactions, and sometimes they're even leveraging this. They're leveraging money that isn't even theirs. And another thing to understand about this is that one of the ways to bet on a stock price going down is shorting, which is done by borrowing shares. Now, borrowing is a key word here. Institutions are lending out shares to people who want to borrow them to bet on the price going down. But at the same time, those shares that they just borrowed, they then take those shares and sell them, which creates an excess amount of shares in the market. And that's exactly what's happening to Duolingo right now. Another thing to note is that there's 5.36 million shares short on top of the 40 million shares already outstanding, and that is 13.52% of the entire float, of which 100% of it is already owned. Now I'm going to hand it back to Johnny to explain more of why this is happening.
Why are these shares being basically duplicated? Well, that is where we get into synthetic short laddering. So what is synthetic short laddering? This is essentially mimicking the action of what we just talked about, which is shorting shares. So to short shares, you have to borrow shares, and that lets you bet on the price going down, which lets you make money from the price going down. Now, synthetic short laddering is mimicking that with derivatives, specifically options. So if you look over here, you're mimicking it with a long put and a short call, and this mimics the payoff structure of shorting a stock, but it's not the same thing. It's mimicking it. That's the key idea here. It is mimicking it. So they are not actual short positions, so it doesn't get reported in the short interest numbers. And that is another key thing here, because what's happening with Duolingo is that you can't really see the numbers behind what's actually going on behind the scenes. And I'm pretty sure there are a lot of synthetic short positions in the market. And you just have to logically think to yourself, 100% of the float is owned, yet the stock is down 70%, and it has stellar financials. It blew their last earnings out of the water, just obliterated expectations, and it's not adding up. So there's three specific ways you can bet on price going down. That is shorting shares by borrowing them, synthetic shorting, and naked shorting. And the third one is not legal, yet it still happens, and there are some gray areas, but essentially, if someone is naked shorting, that means they're not borrowing them, and this is creating what are called phantom shares, and that results in failures to deliver. So I thought maybe someone is naked shorting Duolingo right now, so I looked at the failures to delivers, and the numbers are not adding up. So naked shorting is out of the picture, and it's either synthetic short laddering and or spoofing that is driving the price down. So we can rule out naked shorting because there just are not enough naked shares or failures to deliver in the market. So we can rule that out. Now, what does synthetic short laddering have to do with rehypothecation? Because I said this is why rehypothecation is happening. So let's kind of recap what both of these things are. So, synthetic short, what is a synthetic short? That's buying a put and selling a call at the same strike and same expiry, and this gives you negative delta and short exposure. So, betting the price goes down, and that creates short exposure without selling a single share. So, who's on the other side of this? It's the market maker, right? They are short a put and long a call, the opposite. And this results in a positive delta and long exposure. So as the price is continually going down, these market makers have to hedge that exposure. They have to hedge their negative delta, and they do this by shorting shares, shorting the underlying stock, shorting shares. So it's not the synthetic short position that pushed the price down, it was the effect of that position being taken, which forces market makers to delta hedge. That is the key thing here. So scaling these synthetic short positions, they're usually placed at multiple lower strikes, usually near term if that is where the effect is highest. Now, why is the effect highest? We're going to talk about that a little bit before moving on. So to understand why the effect is highest, you need to understand gamma, or at least know what gamma is. And this is really the key driver of this whole laddering concept and why it's driving the price down. So this is called the gamma curve, and to understand this, you kind of need to understand what gamma is. So let's take a quick look at that. I'm not really going to go too in depth, but basically, we've been talking about delta hedging, and gamma, so we keep saying the word delta, right? Like delta, exposure, delta neutrality. So what does gamma have to do with this? So gamma is affecting delta. These are components that move the price of options based on their own components. So gamma is a measure of how much an option's delta changes with a $1 move. So if you look at the bottom, if an option has a delta of 0.5 and the stock increases, the gamma gets added to the delta, and now the delta is 0.6. So think to yourself, if it goes up another dollar, delta is going to go up to 0.7. And every dollar increase, the delta is getting added to the option value. So the first dollar, the option increases by 0.5, and then 0.6, and then 0.7. Now think of about $20 increase. The option is now increasing at instead of 0.6, it's increasing by whatever that is, 3.7. So it's this exponential effect, right? And that is why, well, to understand the why, we're going to take a look at the gamma curve. So the gamma curve is highest at the money, which means where the current stock price is. So if we were to take a look at, let's take a look at Duolingo's options chain, so you can really see what I'm talking about. So here is the option chain for Duolingo. Now it may just look like a lot of numbers, so we're just going to do a quick run through of it. These are the option strikes, so this is where you can bet the stock is going to. This is the current price, which is called at the money. Here, this is what people want to buy it for. This is what people want to sell it for. Now what we want to focus on is the pricing component, so the delta and gamma specifically. Now, if you look at the money, which is the current price, right now it's $199.75. This is the at the money strike. Well, we'll call it at the money. And so if you look here, the gamma is 0.016, and if you look out here, it's 0.000, literally 0. So if we look at the gamma curve, this is exactly what it means. If you take these numbers and you plug them into a chart, this is what it's going to look like. If you plug these numbers in going both ways. So what does this number have to do with market makers having to delta hedge? Because that's the whole thing I'm trying to explain and clarify. So if this goes up $1, this number is going to get added to the delta, and the delta is going to grow at an exponential rate. So the delta exposure that these market makers are exposed to gets increasingly larger the higher the price goes, and vice versa. So it's not a static number. Like as the price changes, the delta exposure changes, and they have to adjust to that delta exposure change. And if their exposure is to the downside, that means the more the price goes down, the more they have to short to cover their downside exposure. That is the whole concept here. And that is why synthetic short laddering results in rehypothecation, because they are taking synthetic short positions, which causes the market makers to have to delta hedge by shorting shares, which pushes the price down. It's a feedback loop, and I'm going to reiterate this when we get back into the slides I was just talking about. So let's get back into why everything is just working together the way it is. So now that you understand what gamma is and why it affects the stock price, we can talk about how it really just all comes together. So synthetic shorts are placed at multiple lower strikes, usually near term, as that is where the effect is highest and forces market makers to delta hedge even more, which means shorting more, which means driving prices even lower. It's a feedback loop. Price goes down, they have to delta hedge, which brings the price down, and it's just this continual cycle. That's why it's called laddering. It's laddering the price down. And this is exactly what it looks like. I'm gonna show a picture of what's called GEX exposure, and you can see where gamma concentrations are, where market makers and people are literally concentrating their money, and they can do it systematically, strategically, to manipulate prices like the way I'm talking about. So increasing negative delta, as the price goes lower, the market maker's delta also decreases. And what does that do? It makes them have to hedge even more. So this forces more short hedging, which means more selling, forcing the price down lower. And then it's just that feedback loop I was talking about. This is what synthetic short laddering is. Now, how does this connect to rehypothecation? Because this is the connection I've been trying to make. Market makers have to hedge by borrowing shares, shorting shares. So let's talk about rehypothecation again. Borrowed shares can be relent, and then they sell them again, and then they relend them out. And this is rehypothecation, the whole Apple analogy. So what is the amplification effect here? More hedging equals more borrowed shares, which means more rehypothecation, which means there's a bigger capacity for synthetic shorting. So to summarize everything, market makers hedge, that forces selling, and rehypothecation amplifies it. And it all starts from synthetic short laddering that forces them to hedge. So by synthetic shorting, it's forcing this cascading effect where they have to hedge, and they just keep forcing them to do that as the price falls lower. Now, the other manipulative component that is sometimes deployed in the market is called spoofing. And I'm not going to spend too much time on this because while I was making this, I kind of came to the conclusion that this isn't the method being deployed because it's too liquid for this to drive a stock, or it's too liquid for spoofing to drive the price of Duolingo down 70%. But it is used much shorter term, and I think it's kind of a cool concept, so I wanted to share it. So spoofing has to do with what's called the depth of market, and I'm going to show you what it looks like in the heat map so you can literally see what it looks like when it's happening, as it's pretty cool. But basically, spoofing is where market makers, or somebody is just spamming limit orders into the market that never get filled, but it still influences the stock price. So what does that really look like? This is the current price. You have limit buy orders and limit sell orders. And basically what someone is trying to do is drive the price higher or drive the price lower. And I think it might help if I visualize this. So this is what it looks like visualized. This is called a heat map. I know it looks a little scary and complicated, but really it's pretty simple. This right here is the price of a stock, just displayed differently. These are volume bubbles, and they get bigger the more volume there was in this time interval. So let's say this is 5 minutes. This is a 5-minute bubble. This is a 5-minute bubble, 5-minute bubble. That's it. That's what the price is. These are limit orders. So up here you could say there's 5,064 limit orders waiting at 79.89. That's it. This is the price, and these are limit orders. That's it. Where it's black, there's no limit orders. Where it's bright, there's a lot of limit orders. Now, what these market makers do, or whoever it is, they systematically and algorithmically are inputting these limit orders underneath the price. They don't get filled because price is up here and these limit orders are here. And a limit order doesn't get filled until the price gets to that limit order. So This is creating a fake demand, a fake idea of demand, which is driving the price higher. And the whole concept of this is so that whoever is doing this can short at a higher price, and then they remove all these limit orders like they were never even there, and then they can close their short position wherever and they make money. None of these positions got filled. They never entered a long position. These are all long limit orders because it's below the price. So, I mean, I guess it could be shorts, but that's pretty unlikely, considering there's just a lot of assumptions that I'm not going to spend too much time going over. But essentially, they're putting in limit orders that creates fake demand, drives the price higher, so that they can short, price comes down, every order disappears, and they make money on their short position. That is what spoofing is. So let's talk about what is so suspicious about these executives, what they're doing, and just what I'm finding that is really bizarre to me. So we're going to take a look at these institutional orders, okay? These are all the orders put in, it was submitted through 13F filings by investment funds. And the first thing I'm going to point out is on 11/14th, you see a lot of specifically quant funds, not like banks like JP Morgan, quant funds, take delta neutral strategies, which is essentially call, puts, and shares. They're some sort of strategy where they're combining derivatives and the underlying stock. So you can see Millennium does that, Square Point, Q, Peak 6. These are all quant funds. And what stands out is that you don't see this kind of strategic positioning anywhere in like the last year. You see Susquehanna do it, which is another quant fund. D. Shaw, like just look for yourself. And what happens right after 11/14? So 11/14 is right here. Days after, you get all the executives selling a lot of shares, and then followed by Severin Hacker, the co-founder. And this seems to be the pattern every single time at these like extreme highs, basically. You get major orders by the executives followed by Severin Hacker. Major orders done by all the executives followed by Severin Hacker. And Severin Hacker seems to know when the stock is about to drop within days. And he does these orders every single time. Now, I understand that these executives have to do these filings to sell shares ahead of time, and it's not like they can just sell basically whenever they want. It's a very rigorous and like legal process, but it's very systematic. So we're gonna go back to 8/14, which was another period that stood out to me, where you get this gigantic where'd it go? You get this gigantic clustering of sell orders, which you don't see anywhere else. And what happened after 8/14, or when was 8/14? Right here, followed by the executive selling, followed by Severin Hacker. Like, it's just really bizarre to me. It looks very synchronized, and it's very coincidental. It doesn't necessarily mean it's proof, but it just looks very synchronized to me. So I'm going to leave it at that, and we're going to move into some more numbers. So I reached out to a bunch of my friends that are doing quantitative trading in that realm, exotic derivatives trading, and they have access to a lot more information, so like the Bloomberg terminal, etc. And so they sent me this, which is the short positions on Duolingo held by institutions, the biggest short positions being held. And what do you notice? They're all quant funds. Like 9 out of the top 10, at least that I'm aware of. I don't know Sessa Capital, but SIG, Citadel, Jane Street, IMC, Wolverine, Millennium, Square Point, Peak, Deshaw. Those are all quant funds. And that is what I was suspecting when we looked through the all these orders, right? And it's really bizarre to me. It just kind of came out of nowhere. All of these quant funds are starting to deploy these strategies, right in line with these executives doing major sell orders at pretty much the major highs right before those enormous declines. And some other pictures right here, you can see, putting them right next to each other, that they're just happening in line. It's just looked so synchronized to me. So what does this mean for the bigger picture? What do I think is going to be the outcome of this? Alright, so what do I think is going to be the outcome? So we're going to do some analysis on the microstructure now and really just kind of talk about what is probably going to happen. So what is the main thing that needs to be understood is that when a short position is taken, it has to be reversed at some point. And that's how someone who's shorted makes money. They close their short position, which was borrowed, so they have to buy it back, and that's ultimately going to make the price go up. So there's two components here. One, you have 14% of the float being shorted, which is not insanely high, but it's an okay number. But that is likely a result of a lot of synthetic short positions being taken, which aren't reported in the short interest. So you have an okay amount of short interest and likely a lot of synthetic short positions. So you have two components that have to be reversed at some point that are going to result in driving price higher. And there's really three main areas where Duolingo is very, very likely to bottom. That is 172 to 218, which you can already see we've actually had some reaction to. Like, we've bottomed there because this is a huge demand zone. But if this area doesn't hold, if you take a look at the weekly MACD, this is still signifying that we could potentially see one more decline. And we would either bottom at 131 to 145, which I think is a very, very big area due to two key reasons. One, we would get a major liquidity sweep here. So you're going to have a lot of stop losses right here. And once that gets swept, that just clears up a lot of liquidity for people to exit their positions. You would see a lot of positioning being done here for a reversal. This is a key, very, very likely area price will bottom at if we get here, as well as it would mitigate a order imbalance right here, and you also have one here. So this is another area of incentive, 86 to 106, but this is really a key area I'm watching here, 131 to 145, as there's a lot of incentive to go here and bottom here. And once these positions get reversed, we're probably going to see a gamma squeeze, which is essentially this, but in reverse. And the mechanics are a little different. It's not synthetic, like, long positions. It's essentially just all of these synthetic short positions being unwound, and then on top of that, as the price is going higher, these market makers are going to have to delta head to the upside now. So it's going to be this effect, but in reverse. So I think this is really likely to experience that at some point. And the one thing I can't say is where it's going to bottom. I can say where it's likely going to bottom at, as this decline is starting to get a little absurd, as there's really just not a foundation for it. You could say that it was overvalued, but the thing about the microstructure is that you really kind of have to experience mean reversion in these kind of environments. And mean reversion is basically just saying, if you get a big move down, you're going to get a move up, and vice versa. Big move up, you're going to get a big move down. And that's essentially what all of my trading strategies revolve around, mean reversion. That's for another time. But yeah, really, that is kind of the summary of my whole thought process on Duolingo. And I think at some point we're going to get a big move up. And just from analyzing the microstructure, there's going to be a lot of supply in this region. So I think if we start moving up, it's going to have a very difficult time getting through here. But an area of incentive would be probably this region. I would be there's it's kind of difficult to say, but I think a big region would be the high to mid 300s. And honestly, that's kind of that's a high conservative target. If you're looking for a more conservative target, you would be looking for 260, which is $60 away. That's a lot of money could be made from that. And then you would hit a supply zone. So that's really kind of my targeting what I'm looking for, if we keep going down, I would probably be taking quite a large long position here. But we will see how this goes. This is just my documentation of what I'm finding. Do what you will with that information, and we'll see how it goes.